G'day folks, welcome back to another edition of Pete's Investing, the Easter edition. So if you're Christian, hope you had a good Easter break so far. And if you're not Christian, well, hope you still had a good Easter break anyway. So here we're looking at the Euro-US dollar. We don't often do Forex, but someone did ask me for a review of a Forex trading. Does a strategy work with Forex? So I'm using the Euro-US as an example. So here we are. And the Euro-US charts are showing long positions on our charts, but just watch out for that bearish retrace. In terms of the outlook, as of today, April 21st, the euro has strengthened against the US dollar, reaching multi-year highs driven by capital flights from the US amid escalating trade tensions and concerns over US economic growth. In response to the euro's rise and potential deflationary pressures, the European Central Bank cut its benchmark interest rate by 0.25% to 2.25, marking the seventh rate cut since June 2024. The US dollar has weakened due to new tariff imposed by US administration, leading to increased recession risks and a decline in investor confidence. Despite the ECB's rate cuts, the euro's strength persists, reflecting market skepticism toward the US dollar rather than confidence in the euro. The euro-US pair has experienced volatility, with recent forecasts suggesting a short-term correction as traders reassess Federal Reserve policy expectations amid evolving global trade conditions. So first we look at the general trends on our time frame. So we've got the monthly, the weekly and the daily. So on the monthly you can see here the price is broken above the moving averages, and so with the CCI at 150. So they're both bullish at the moment after a bit of a dip in the last few months. So bullish momentum at the moment on the monthly. On the weekly likewise, you can see there a strong rise above the moving averages of the CCI and the moving average of the price. So bullish movement on the weekly as well. And also on the daily, you'll see there it's still rising. Now you'll notice here the CCI dipped initially there, then it broke above again, and we've got it currently, the CCI has broken into that moving average range on the daily as well, showing some potential weakening. Also, if you notice as well, if I zoom in on the daily for a moment, we do have a slight bearish divergence on the CCI, lower highs on the CCI versus almost a double topper or slightly higher highs on the price. Now the price can still rise. So long as the CCI keeps dropping and the price still rising, we're going to consider that a bearish divergence. So that's the first sign of a potential weakening so far. Now if we go to the intraday charts, we look at the 1 hour chart as an example, and I like the 1 hour chart because it gives us a lot more volatility in terms of any divergence. So again, let's look for any divergence where we are currently. Rise or almost a double top on the price, and the CCI is still hasn't reached a peak yet, hasn't gone higher than that previous high. So that in itself is a bearish divergence on the 1 hour time frame, and that is different to the daily. That divergence, it's an independent divergence. Also notice back here we had a divergence, lower highs versus higher highs. That actually dropped as well. It retraced there, and if we draw a Fibonacci from that high, we take it back to the significant low, which would have been that low there. You can see there the 23-38% level is a minimum range we look at, and it broke into that range and it bounced out of it. And a lot of the time it does that, it bounces out of that minimum range. So that's on the 1 hour time frame. So what we do now is we got the back test here for long positions. So what we do back, I'm going to go back to this area here just to demonstrate how you would have gone long during this period on the daily if you're trading on the hourly, and how you would have gone short during that period and then long again this period. So I'll go through each of those stages. So again, during this period back here between July and October of 2024, you would have gone predominantly long on the 1 hour time frame. And that 1 hour time frame, I've got it back starting back there and ending at that point there. So again, during that period, you would have taken long trades during that period. How do we do that? How do we measure that? So if I zoom in here on the daily first off, get right in there and do the same thing on the 1 hour time frame, and zoom in there. So as I said, we go long when this CCI 1500 down here breaks into a long position. So what we want to look for is, number one, this indicator breaking into a long position like it is here, and also the CCI 150 as well above its moving averages, and the daily above the moving averages. So again, using that as an entry point, we do the same thing on the 1 hour time frame. So back there, whenever that CCI breaks above the moving averages, and the price also breaks above the moving averages on the 1 hour, and that's also long, we take long positions. And up here I've got the stop loss approach. So I take profit of 0.003% on both the stop loss and the average down, and we stop it out when it drops by 0.005%, and we average down when it drops by 0.005, but then we wait for another new entry position or entry condition to enter another long trade. Now you'll notice there it averaged down 3 times, and there it averaged down once. It entered a single trade there, and it averaged down once there, etc. Now I'll show you how to avoid this drawdown here. So what we do is we go long when the CCI 1500 breaks long here on the daily. The CCI 150 is also long, and the price is also above the moving averages. So you take those long positions, as I said, in that condition. Now here the price pulled back, and you let it go. You still trade in and out with those plus 0.003% take profits, and average down when it, or stop loss when it breaks down to 0.005%. You would have kept going until you notice here the CCI kept moving in alignment with the price. That dropped off, so did the price, made another, that was a higher than that previous high, so that's moving in alignment with the price, higher highs, let it go, higher highs, to that point, higher highs, higher highs. Now up until this point, you'll notice the price started pulling back. The CCI also pulled back, and in that little area there, there's no sign of a bearish divergence yet, because the lows or the highs until that period, see that period there, lower highs, up until that point, there's no divergence. That's moving in line with the price. The lows there are lower, then it starts breaking higher. Now you'll notice here the price broke higher, and that was your first sign of a bearish divergence. Actually, no, a lie, that's not right. It started breaking higher there, a higher point there, I've drawn it there, versus a lower high there. So that was your first sign of a bearish divergence. So theoretically, you would have closed out your positions on the 1 hour time frame when you started noticing this break below on the CCI 150. Now that would have been a bit early there, even though that was showing you long positions. You would not have taken long trades, because why? Because the daily is below the moving averages there. So that's your first exit on the 1 hour time frame using the daily as a reference. So that would have been your long trades. And so had you got out at that point there, and you'll notice here on the right side at this point here, you would have got out near the highs there. So the stop loss approach, you would have made $57, and the average down approach, you would have made $459. Okay, so that was the long positions there on the daily. So now what we're going to do is we're going to switch to the short positions based on the daily. So let's zoom in again, and then we're going to focus on this area. So what do? We take short positions in this period where that CCI 1500 is showing predominantly short. So again, remember, we closed it out on the long positions. We closed it out when that CCI 1500 broke below the moving averages on the daily after that bearish divergence. So now we start taking short trades in this range here, in that range there. So that corresponds with this period here on the 1 hour time frame. So from that, again, we got out of the long trades at that point there, and we trade up until that point on going short only. And this is the short back test. I've got the stop loss approach up here and the average down approach here. So again, I'll show you how to avoid the drawdown again where it started gaining here. So now we take short trades. The CCI 1500 is broken down. It's confirmed by the CCI 150 below the moving averages and the price below the moving averages. So we start taking short trades with the same conditions on the 1 hour time frame. Again, you just follow the daily. It breaks above the moving averages. That breaks above the moving averages. So that's aligning, the CCI 150 is aligning with the price chart. The CCI drops, the price drops. We've got lower lows there, lower lows there. At that point there, lower lows, lower lows. Now we start, you'll notice here the CCI starts rising, the price starts rising. That low there is higher than that low, and so is that price. So no divergence yet. Keep following it. CCI there, that low's there, That low is there, so it's still moving in line with the price. So you still take those short trades on the 1 hour time frame until you come to this point. That low there is still higher than that low, and that low now is lower than that low. That's your first point of a bearish divergence up until that point. So theoretically, you would have stopped taking short trades after that first bearish divergence shown there. Now in this case, the price kept dropping. Just get out of it. Don't hold on to it. Don't keep taking short trades. You would have got out on that first bullish divergence after that point there. And that corresponds with, see on the right side there, that corresponds with this period back here. So you'll notice there on the stop loss approach, had you got out there, that generated $438, and the average down approach generated $479. So again, I'm going to pivot to long positions, because as I said, we've got this bullish divergence, and you would have taken your last short trade at that point there. So now we're going to start taking long positions. So we start theoretically from this point here when the CCI 1500 breaks long. Now I'll explain this bearish trend here on the CCI 1500 in a moment, but predominantly long trades from that point on. Now you'll notice here the CCI 150 at that point, the CCI 1500 was long, and so was the CCI 150, and so was the price above the moving averages. Now at this point it dipped below the price and it dipped below the CCI 150, but notice the lows were still higher. Let me just draw a little trend line. Those lows were still higher than those lows. So again, the price and the CCI are moving in alignment. So you don't panic, keep holding long positions during this period. And that, by the way, corresponds on the 1 hour time frame from about this point here. From that point, you would have taken long trades. So even though the price retraced, you would have averaged down once during that period. So what do? Again, you would have held those long positions, and then the CCI 1500 confirmed long, and again the CCI 150 on the price also confirmed long positions. So again, you track the daily. So higher lows, higher lows. It broke above again on both the price and the CCI. Again, remember we're going long here now. It broke down below there, higher lows, broke above again, keeping the long positions. Now you'll notice, as I said on the opening of this, on the daily, we've got a bearish divergence. So that's your first sign of a potential reversal. Lower highs on the CCI versus higher highs on the price. So, and you'll notice here as well on the 1 hour time frame, we've also got another lower highs so far versus higher highs on the price. Now, you could actually take note of that now and take your profits. And you'll notice here the average down approach has actually closed out and hasn't re-entered yet, because we enter when it's a fresh breakout above the CCI 150, and it's also a fresh breakout above, or it's above the moving averages of the price. So that's where you enter the trades. So at this point, had you gone long, that would have broken above from let's say from that point, you would have taken long positions. So what I've done here, I've started the back test now from that position where you would have gone long, just to prove the profitability had you stayed in that position. So the stop loss approach, it did actually dip below our break even of 100,000, but it ended up, had you stayed in the trade, with $207 return, and the average down approach would have generated 826, with a few average downs happening in that period there. But again, like I said, at the moment, if you were going long, I'd be taking the money off the table. You don't want to risk this failing, because we've already seen a start of a potential bearish divergence on the daily, but also a bearish divergence also the beginning of on the 1 hour. So probability is we're going to see a start of decline coming in the next few hours. So just keep an eye on that. Now, if it does break higher, obviously, and the CCI does also continue higher than the previous highs on both on the 1 hour and also the daily, then we can start taking long trades again. So if you're new to trading, we're now including a weekly video series, Pete's Investing Plus One, as part of Pete's Investing channel. The Plus One videos are a dumbed down version of our strategies, giving you a better insight into our analysis and help you follow our daily videos. If you enjoy the content and help keep me motivated to keep doing these videos, subscribe at least to a free trial to my Patreon page, where I publish weekly bullish shares across various regions of the world's markets. Think of it as sitting down with me over a cup of coffee. Thanks, and talk to you in our next video.